Hey guys, Daniel here and welcome back to another video. This is going to be a video more directed to people who are interested in or own Dropbox stock. Ticker symbol DBX. They just reported earnings after the bell and are down around 3.5%. And in this video, I'm really going to separate and talk about three things. Dropbox earnings, what I think about those earnings and how they impact the company and the stock price, as well as my updated long-term thesis on the company. This is a company that I analyzed back in the early days of my channel. I think this was my first video, a Dropbox analysis. If you want to see that, it'll be the first link in the description. I go through the business model, financials, revenue growth, and my bullish thesis all together. So Dropbox now at a market cap of around $10 billion. And this is a stock that has been on a run since November, now trading at around $24, or I guess after hours, a little over $23 per share at a market cap of under $10 billion. So in terms of analyst expectations, which is what we want to look at first, before we take a glance at these earnings, analysts for Q4 of 2020 were expecting around 24 cents of earnings per share and under $500 million in revenue. Now, if we take a look at what Dropbox actually reported, total revenue was $504 million, a beat on revenue, absolutely huge. And this is something that Dropbox does consistently. They consistently beat revenue and beat analyst expectations. And this is some of the, kind of one of the things that proves how underappreciated the stock is. It's been on a downtrend ever since its IPO in 2018, where it made highs of around $40 per share. It's halved in price since then, essentially, despite consistent beats in revenue growth and earnings. So anyways, total revenue was around $504 million, an increase of 13% from the same period last year. Now, again, this is very strong revenue growth and much more than analysts were expecting. But if we look at annual recurring revenue, we can see that it was over $2 billion, or ended the year over $2 billion, an increase of 41.2 million quarter over quarter, and an increase of 11% year over year. Now, this is big, as it really kind of shows that Dropbox is now a company that will be making over $2 billion on a yearly basis. Paying users. This is one of the most important metrics when it comes to Dropbox, along with revenue per user. Paying users ended at 15.48 million as compared to 14.31 million for the same period last year. Over the span of the year, they added over 1 million users. Big growth coming from Dropbox. And not only did they increase the amount of users that they had, they also increased the revenue per user, which is something that's really kind of unique to Dropbox, how they managed to not only increase their their customers and paying clients, but also the amount of money that those clients pay by introducing new features and raising the prices slightly every year. So average revenue per paying user was $130.17 as compared to $125 for the same period last year. Now, Dropbox is one of these services that demands a higher premium on their product. They are, a little more expensive than the generic OneDrive or, Google Drive, but users like Dropbox. They have a very interesting product that is unique in its own ways. Users pay for that, and they're willing to pay for that, which is why we see not only an increase in users, but an increase in amount those users pay. Next, we have gross margin, which ended the year at around 79% as compared to 76.5% in the same period last year. Not only is Dropbox growing revenues, but they're also increasing the profitability of that revenue, which is something we want to see in a business. Not only are they growing, but they're growing profitably, and they're becoming more profitable as we go forwards. Next here we have non-GAAP gross margin, which is a little higher and doesn't include a few expenses. Next, we have GAAP operating margin, and this is where we have to really consider one major thing actually. The fact that Dropbox went through one big one-time payment due to the restructuring of essentially one of the main components of their business, their workforce. Originally, Dropbox had big offices that costed them a lot of money, where workers would go and work for Dropbox, right? Now, as of Q4 of 2020, they moved their entire workforce and transitioned them to online and virtual. using the Dropbox virtual workspace, which is great, a great validation of their product. The fact that they're using it is very big as to product quality. Now, although this is very beneficial to the company's profit margin going forwards, this does create a few one-time expenses, which is why, certain metrics show that Dropbox did post a loss, because factoring in these one-time payments, they did. So we can't really look at this as of right now, but we know that going forwards, Dropbox will be more profitable than ever, and management is continuing to find ways to save money. Now, if we look at net cash provided by operating activities, around $170 million, down from the same period last year, again, due to that one-time payment. Free cash flow down a little bit since last year. Again, these would be significantly higher if it wasn't for that one-time payment. I'm assuming that net cash provided by operations would be over $200 million by a substantial amount. I think it would be nearing or over $250 million. And free cash flow would be nearing $200 million, in my opinion. Now, obviously, we'll see next quarter. I think next quarter is where we'll start to see the impact of this move and transition of the workforce into an online environment. So next year we have earnings per share, and again, we can't really look at this because of that one-time payment, and so we have a loss of 84 cents per share, right? So if we look at non-GAAP diluted net income per share, we get around 28 cents, and that obviously discludes that one-time payment. So at 28 cents per share, that is significantly higher than analyst expectations, a beat by over 10-15%. Obviously a big beat, and again, showing off Dropbox's ability to consistently beat on analyst expectations, which is very good for the company. Next year we have cash, and the amount of cash that they have on their balance sheet, which is now $1.12 billion. Again, Dropbox has an incredible balance sheet, very little debt, and over $1 billion in cash. There's no, and they're profitable as well. Let's not forget about that. So Dropbox is perfectly poised to make possible acquisitions going forwards and to fund their business. Bankruptcy is pretty much out of the risk for Dropbox. They have a great balance sheet. They have a profitable business model. They have a growing business model. They have a proven business model. And if worse comes to worse, they have possible dilution. But why would they dilute if they're doing share buybacks? Dropbox recently announced that they're doing a share repurchase program. As of February 12th, the board of directors authorized Dropbox to repurchase an additional $1 billion of its Class A common stock. The repurchase is expected to be executed subject to general business and market conditions and other investment opportunities through open market purchases or privately negotiated transactions. Now, this shows the profitability of Dropbox's business model. And normally I don't really like companies doing share buybacks, as it's kind of a way of telling people that we don't really have anything to do with our money except buy back our own stock. But in Dropbox case, they're such an undervalued company that it honestly makes sense for them to repurchase shares. And that obviously makes earnings per share and, or rather, yeah, their earnings look a little better. But again, for now, I think this is fine. If Dropbox's stock gets a little more appreciated and goes up to higher levels, maybe $40, $50 per share eventually, I think a share repurchase isn't as efficient, and more of a direct dividend would be better appreciated by the market. But I see what they're doing in here, and I fully agree with their decision to do this buyback now when their stock price is still significantly down from 2-3 years ago. Now, up here, we have a statement by Dropbox's CEO. 2020 was a transformational year for Dropbox, and I'm proud of the team for their resilience and focus in addressing our customers' evolving needs, said Dropbox co-founder and chief executive officer Drew Houston. We ended the year with strong margin expansion, free cash flow, and more than $2 billion in annual recurring revenue. As we continue to build out or continue to make progress towards our long-term financial targets. Going into 2021, we're focused on executing against our strategy and building essential products for the new era of distributed work. Now, when we look at my long-term thesis for Dropbox, one of the main things that I look at is expecting them to hit $1 billion in free cash flow by 2024, maybe 2025, but I really expect them to hit that by 2024. If they do that, this is a $10 billion company currently. And if they're essentially creating $1 billion in cash every year, you can expect a significantly higher share price, especially if they hit that. Now, if we look at cash flow here today, we can see that it was around $490 million for the year of 2020. Now, if we didn't have those one-time payments, rather from the transition of workers to the online environment, I think that would be closer to $450 million, if not $600 million in free cash flow for Dropbox. And in my opinion, Dropbox is perfectly positioned to hit that $1 billion in free cash flow by 2024. I think Dropbox can do it, and that's one of the very kind of bullish things that will come to Dropbox if they manage to execute on that. So if we look at my kind of price targets here from my analysis video, October the 27th, over the next 3 to 5 years, worst case scenario, I saw the stock going to $40 per share, and this was essentially expecting a halt in revenue growth for Dropbox, them not hitting that goal of $1 billion in free cash flow, and things not really working out for the business or the company. Now, in my opinion, this is a very unlikely scenario, as they've proven a lot and have a product that has coexisted with Google Drive and OneDrive over the past 5, 10, 15 years. So that kind of concern of competition and them crushing Dropbox is out of the question, because if they would have crushed Dropbox, that would have happened a long, long time ago. Now, my base case scenario, or my kind of average price target, was around $60 per share, and I still agree with that. I think $80 plus comes if they absolutely destroy that $1 billion in free cash flow and get closer to, maybe like 1.2, 1.3, maybe not 1.4, but maybe like 1.3 billion in free cash flow by, like 2025. If they can hit that and they execute on a higher level, HelloSign, which is kind of like their DocuSign competitor, goes very well. If things go well for the company, I could see them hitting $80 plus. Now, obviously, this is a little more unlikely and a little more on the bullish side. You really need to be bullish on Dropbox to expect them to go to $80 plus, which is why I have my current price target around $60. So with the share price being around $24, $23, you could expect at least like a double up in the next 3 to 5 years. So at this point, it really depends on what you want in a company. What returns do you want? I think Dropbox is a very stable stock, and it's not one that's going to go crashing down 50% if the market crashes, like it did in March. It's more of a stable stock, and it's one that's very underappreciated by the market. I mean, if we look at the forward PE for this guy, it's around 23.6 forward PE for a company growing revenues by double digits. So in my opinion, Dropbox is a very intriguing opportunity. They have a great opportunity from a business perspective and revenue growth perspective. I think this kind of dip here is a little on the overreaction side of things. I'm guessing it happened because of the run-up that Dropbox had over the past couple months here, increasing value by like 35%, I think, from the lows it hit back in October. But again, this is really just a decision that you have to make. Evaluate yourself as an investor. Evaluate your portfolio and see if Dropbox fits that. See if you're comfortable or if you want a more stable stock in your portfolio. Because I can tell you, Dropbox isn't really the type of company that's going to go jumping 20, 30, 40% in a matter of weeks or months. Outside of the scenario of possible acquisition rumors, like what happened back in like December here, where I think it was rumored that Microsoft or some other company was going to go out and buy Dropbox. Obviously that didn't happen, but that's fine. Dropbox now at around $23 per share. Again, evaluate it yourself, come up with your own price targets. I hope you guys appreciate this video. If you're new, make sure to hit that subscribe button. Thank you so much for watching, and have a great day.